I am a chartered banker, and today I will delve into the 3 bank stocks to buy in 2026 and the 2 stocks to avoid the same month. Most investors who are telling you to buy bank stocks have never prepared a single loan loss provision in their lives. They look at a green chart and scream, buy, and hope for the best. But banking is not hype. It is about knowing about balance sheets interpretation, computation of risk management, capital ratios, and survivability. By the end of this video, today, I'll delve into the 3 bank stocks I'll buy in 2026, and 2 to avoid. You'll learn about how professional bank analysts actually evaluate bank stocks. These are 5 metrics retail investors sometimes ignore, which are namely the bank stocks I'm personally bullish on in 2026, and the 2 companies' stocks I believe investors should avoid completely. So before we begin, subscribe to the channel right now, because this channel is all about smart investing, financial education, and helping everyday people think like institutional investors, not gamblers. As a chartered banker, I've worked on credit risk management, credit lending decisions, relationship management, and financial analysis. So today, I am not using TikTok investing logic, I am using real banking logic. And trust me, the first bank stock I'm buying is probably not the one you expect. The Banker's Framework is a 5-step methods for solving strategic, complex, or I-related challenges in the banking sector, known as the 5S framework: state, structure, solve, stress test, and sell. Let me show you how real banking professionals evaluate banks' performances. Most retail investors focus only on price-to-earnings ratio or dividend yield. But in banking, you can mislead by those numbers alone. So here are the 5 metrics I personally check before buying any bank stock. 1. CET1 ratio. Graphic. CET1 capital. Number 1. CET1 ratio, also known as Common Equity Tier 1 capital. This measures how financially strong a bank is during the period of stress. Think of it like a financial shock absorber. If the economy crashes, loan defaults rise, or depositors panic, does the bank have enough capital to survive? For me, anything above 13% is strong. If a bank has weak CET1 capital, that's a red flag immediately. 2. Net interest margin, NIM. Number 2. Net interest margin, or NIM. This is one of the most important profit drivers for banks. Banks borrow money cheaply from depositors and lend it out at higher interest rates to borrowers. The difference between income they earn and interest they pay depositors is the net interest margin. If NIM is rising, profitability is improving. If NIM is falling consistently, profitability is decreasing. 3. Efficiency ratio. Number 3. Efficiency ratio. This tells you how expensive the bank is operating. If a bank earns $1 but spends 80 cents running the business, that's inefficient. But if they spend only 50 or 55 cents to generate $1, that's excellent management. For me, below 60% is strong. The lower the number, the better the operational discipline. 4. Non-performing loans. Show red warning graphic. Number 4. Non-performing loans, also called NPLs. This measures the percentage of bad loans. Above 2% starts making me nervous. Because once defaults rise, profits disappear very quickly. This is why bankers are obsessed over credit quality. A bank can grow rapidly for years, then one bad loan cycle wipes out everything. 5. Loan-to-deposit ratio. Number 5. Loan-to-deposit ratio. This tells you whether the bank is overlending. If the ratio is above 100%, the bank is lending more money than it has in deposits. That can become dangerous during liquidity stress. I prefer banks with ratio below 100%. Personal banking experience. During my time working as a relationship manager, I personally saw community banks fail because they ignored the mentioned basics. They had weak capital, they had aggressive loans in their books, and their loan-to-deposit ratios went above 110%. When stress hit the economy, they couldn't survive. That experience completely changed how I analyze banks. And honestly, that discipline saved many investors from disaster during the regional banking panic. So now that you understand the framework, let's talk about the first stock I'm buying. And trust me, it's not JP Morgan. Stock number 1 is MAndTBank, Manufacturers and Traders Trust Company, is a large, established U.S. regional bank headquartered in Buffalo, New York. And this is exactly the kind of boring bank Wall Street often ignores. But boring banks can make incredible investments. Why MTB? Here's what immediately caught my attention. CET1 ratio is around 14.2%. That's strong capital. Net interest margin? It is around 3.8%. Excellent for this environment. Non-performing loans? Roughly 0.7%. That is extremely healthy credit quality. But here's the part that impressed me most. The efficiency ratio is about 52%. That means for every dollar the bank earns, they spend only 52 cents on operating the business. That's operational excellence. In fact, that's better than several much larger banks. Why this matters? Many investors assume smaller regional banks are automatically riskier. That's not always true. In fact, some regional banks manage their risk portfolio far better than giant institutions. M&T has historically maintained a conservative underwriting standards. And this is where banker experience matters. Most people hear commercial real estate exposure and panic immediately. But professionals ask deeper questions. What's the loan-to-value ratio? What type of real estate is it? What is the geographic concentration? What's the borrower's quality? And that's where M&T stands out. As of May 2026, commercial real estate headlines are dominated by capital markets disruption, major data center expansion, and office sector uncertainty. Key stories include a $1.8 billion Manhattan office tower refinancing, high-stakes loan maturities facing owners, a booming data center sector led by new firm launches, and continued investment into sustainable, high-tech infrastructure. Yes, they have meaningful commercial real estate exposure. But their underwriting standards are very conservative. Many of their loans maintain loan-to-value ratios under 60%. That means borrowers already have substantial equity in the property. So even during property declines, losses remain manageable. And during the commercial real estate scare, they handled risk remarkably well. That tells me management is disciplined. Why I'm buying? I love banks that prioritize stability over hype. And M&T reminds me of the old-school banking model. Strong deposits, strong underwriting, disciplined expense management, and steady profitability. This isn't a flashy fintech story. This is a real bank generating real earnings. And honestly, that's exactly what I want in uncertain markets. Stock number 2 is Bank of America. Bank of America is a global leader in wealth management, corporate and investment banking and trading across a broad range of asset classes, serving corporations, governments, institutions and individuals around the world. While everybody knows this bank, very few people truly understand why professional bankers like it. The big advantage: Bank of America has one major advantage in this environment: interest rate sensitivity. This is critical. Bank of America is one of the most asset-sensitive banks among the major U.S. banks. What does that mean in plain English? It means when interest rates stay higher for longer, Bank of America earns significantly more money. Management previously estimated that a 1% increase in long-term interest rates could increase net interest income by billions of dollars. And in 2026, higher rates are still a major reality. That creates a powerful earnings tailwind. Meanwhile, many investors remain terrified of recession headlines. But here's what experienced bankers understand. Banks prepare for recessions before they happen. Loan loss reserves. When you see a bank increasing loan loss provisions, many retail investors panic. But provisions are not automatically losses. They are preparation. They're reserves. If the recession never becomes severe, those reserves can later boost profits. And Bank of America has historically been disciplined in this area. Why I like BAC? Another thing I like is diversification. Consumer banking, wealth management, corporate banking, credit cards, investment banking. Bank of America has multiple earnings engines. So if one area slows down, another area helps stabilize profits. Comparison to competitors. Now compare that with some competitors facing more operational or regulatory pressure. That's why I currently prefer Bank of America over certain peers. And importantly, the stock still trades at valuation levels that I consider reasonable relative to long-term earnings power. That combination matters. Quality plus valuation. Stock number 3, SoFi. $SoFi. Now let's talk about the controversial one. SoFi. $SoFi is a digital-first, FDIC-insured financial technology company and national bank that provides an all-in-one app for banking, borrowing, and investing. Founded in 2011, it is a leading U.S. online lender, as of 2026 serving millions of members with high-yield checking, savings, personal loans, student loan refinancing, and brokerage services. Yes, a fintech stock. And yes, I'm still buying it, but carefully. Why SoFi is different? Most fintech companies want the growth of a bank without the regulation of a bank. But SoFi now operates with a bank charter. That changes everything. A bank charter means regulatory oversight, capital requirements, stress testing, deposit access, and importantly, lower funding costs. Credit quality. Now here's what impressed me most when I reviewed their loan portfolio. The majority of their borrowers are prime and super prime customers. Many have FICO scores above 700. That matters enormously, because in banking, loan growth means nothing if the loans are low quality. And SoFi's non-performing loan ratio remains relatively low. That tells me they are managing credit risk more carefully than many people assume. The risk, but I'm not blindly bullish. There are still risks here. And this is important. Their efficiency ratio remains high. They still spend aggressively on growth and customer acquisition. So profitability execution still matters. This is not the same stability profile as M&T or Bank of America. That's why position sizing matters. I'm buying a smaller position, not because I dislike the company, but because growth stocks require more caution. The long-term opportunity. What excites me is their niche. They understand student loan refinancing extremely well. They built strong digital infrastructure. And younger consumers increasingly prefer mobile-first banking experiences. That creates long-term competitive potential. SoFi is not my safest bank investment, but it may have some of the strongest upside potential. 2 bank stocks I'm avoiding. Now let's talk about the danger zone. Because avoiding bad investments is just as important as finding good ones. Avoid number 1 Citizens Financial, $CFG. The first stock I'm avoiding is Citizens Financial. Citizens Financial Group, Inc. is a major United States commercial bank holding company based in Providence, Rhode Island, operating primarily as Citizens Bank. It is one of the top 10 largest commercial banks in the U.S. by assets and deposits, with a 13-state footprint in the Northeast, Midwest, and Mid-Atlantic regions. And the reason is simple: margin pressure plus commercial real estate risk. Their net interest margin has been compressing, and that's a serious warning sign. When bank profitability weakens while credit risk rises, that combination becomes dangerous. Commercial real estate exposure. Now look deeper into the loan book. They maintain meaningful exposure to office commercial real estate, and office properties remain under pressure because hybrid work has permanently changed demand. That means refinancing risk, vacancy risk, and declining collateral values. As a banker, I don't ignore those warning signs. So personally, I'm staying away. Avoid number 2 Upstart, $UPST. The second stock I'm avoiding is Upstart. As of May 12, 2026, Upstart Holdings Inc., $UPST, is trading at approximately $28.27. The company, which operates an AI-powered lending platform, has experienced a volatile period with a 52-week range between $23.97 and $87.30. And I know some people will disagree. But here's my problem: they claim AI can replace traditional underwriting. And as someone who understands lending, that makes me uncomfortable. Why credit models fail? Credit models look brilliant during stable economic periods. But stress changes everything. When unemployment rises, when defaults increase, when consumer behavior shifts, models can break very quickly. And we already saw major volatility in their loss performance. But here's the bigger issue. They don't operate like a traditional deposit-funded bank. And that matters, because during financial stress, liquidity becomes everything. If funding dries up, growth stops immediately. And that's not the kind of risk profile I want in this environment. So for me, Upstart is a pass. Summary and outro. So let's recap everything. Buy M&TBank for operational discipline and strong efficiency. Buy Bank of America for rate sensitivity and diversified earnings. Buy SoFi for digital banking growth and strong borrower quality. Avoid Citizens Financial because of margin compression and commercial real estate exposure. And avoid Upstart because aggressive AI-driven underwriting still carries major risk. Final message, and remember, these are not random stock picks. These are banking conclusions. This is exactly how professional analysts evaluate financial institutions: capital strength, loan quality, efficiency, liquidity, and risk management. That's what really matters. Final CTA. If you enjoyed this video, subscribe right now, because this channel is where we break down investing using real financial knowledge, not internet hype. Also comment below, what's your favorite bank stock in 2026? And if you want, I may do a full deep dive on the most requested bank in the comments. Thank you so much for watching, and I'll see you in the next video.